Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, founder and CEO of Shepherd Wealth Management, certified financial planning professional. Very excited to be back in here today in headquarters studios, Florence, Kentucky. A lot to talk about. We got all kinds of data coming out from a macroeconomic standpoint. Some really interesting surveys being done across America regarding people's current financial situation. I know it's talked about a lot right now in the news regarding the consumer, how strong they are, how they feel about their personal financial situation. So we're going to talk about all of that stuff and a little bit more than that. So we got a lot to talk about today, as is an exciting thing. And I don't have to talk specifically just about the Fed and interest rates for the entire show, which is great.
That's enough to keep my coffee hot. So I'm ready for this.
Not only that, is a fun day. It's the day we kick off the NFL.
Yeah.
Looking forward to the Chiefs losing tonight against the Lions. And I'm sure everybody in Cincinnati feels the exact same way that I do about that. So we'll all be watching here tonight.
I'm sure a lot of people across the country are hoping that the Chiefs win with how good they've been the past 5 years. So.
Yeah. And not only that, I'm not sure what program that game is going to be on. I don't think it's on an ESPN program. But for all those folks that are looking forward to this college football season, the NFL season, and all the pregame stuff that they have on that program. Well, if you're a Spectrum customer like myself, you don't have access to that anymore. Yeah. So we've had to make some changes in our household going to the YouTube live stream, which is cool because we're doing today's podcast on a live YouTube stream anyway. So I've always been a customer, I guess, of YouTube, enjoyed the program. Now I'm watching their TV.
Yeah, we have shifted over to YouTube pretty much exclusively for the podcast. So I have had YouTube TV in the past. I'm currently not a subscriber, but that's change. And I think it's the best service out there. Hulu TV has the same options, but I'm not a big fan of their live TV interface. I don't mind the app so much, but for live TV, it's YouTube for me. So
yeah, I haven't had an issue with Spectrum so much. I mean, it's never fun calling a cable provider, whoever it is that you may or may not be using. But when we made that phone call to turn off Spectrum, it seemed like they were getting that call quite a bit. Yeah. Because they asked it very nonchalantly, oh, why are you switching? I'm like, well, why do you guys think? They're like, oh, yeah, well, ESPN's being or Disney's being very difficult regarding their ESPN content. So my argument is this is America. And, in America, very simply, football is very important to Americans. So I'm not really sure where Spectrum's coming from in that argument. Other than the fact, I guess their only argument is they don't want to pay the extra dollars for the ESPN program, that content. Yeah. Because their argument is that only a certain percentage of the population of Spectrum customers are actually viewing their content via ESPN. So whatever their issue is, the majority of Americans love football and everything that comes along with it. Right. They're probably not doing so hot right now.
I know football is the number one sports attraction, but for me, NBA is also really big, and Spectrum doesn't have any really, losing any kind of ESPN coverage cuts into either college basketball or, primetime games. So
good for YouTube. They're picking all that business up, and I'm a shareholder. I'm a fan of the product. Obviously, we're doing our podcast here on YouTube Live, so I'm actually excited. I'm glad that this is going the way it is. Only thing I'm not excited about, this is more like a local issue for me, is that I don't get to watch the Reds on TV the way that I've been accustomed to through Spectrum. But we'll make some adjustments, and we'll solve that problem here in a not too distant future. So.
Yeah, pirate stream it out of Sweden. That's what I do. Same thing I can't find.
We'll talk about that after the show.
Yeah,
no doubt. But so I want to start today's show. I know we spent the last 18 months, I'd say, very heavy macroeconomic data. Fed interest rates, inflation, what that means for your money. And we haven't spent, a ton of time on personal financial topics, which is, to me, extremely important. And the data that I'm about to share with everyone here kind of definitely speaks to all of that. So this is coming from CNBC. They did a survey of U.S. Households, and we got some pretty interesting data here. So first of all, the title of this specific article from CNBC, this came out today, this morning at around 6 a.m., September 7th. The title is this: Is financial stress hurting your retirement savings? 4 in 10 workers with a 401k don't contribute, CNBC survey finds. So first of all, 4 in 10 workers with a 401k, so they have the ability to actually put money into a workplace 401k. 41%, 4 out of 10 are saying, yeah, I'm not going to do that. And financial advisors, according to this article, me being one of those people, I'm not saying that this is what my advice would be, but in general, financial advisors are saying paying off, quote, high interest debt while still building emergency savings can reduce stress. Okay, so this is kind of like a Dave Ramsey sort of topic.
Yeah.
Right? Dave Ramsey,
The snowball.
he's obviously created a tremendous amount of wealth for himself. He is giving, sound advice, but it's like ABCs, like alphabet soup type advice, the most generic, high level advice that's out there possible. Of course, nobody wants high interest debt. Like who's out there raising their hand saying, yeah, give me that 27% high interest that I'm going to get on my Capital One credit card.
Yeah.
Well, let's load that bad boy up to its max. Like nobody's out there saying,
Yeah,
that's what I want to do.
Right. No one's saying this interest rate is too low. How dare you?
Exactly.
Having
an emergency savings, of course. Who out there saying, yeah, I don't want to have any sort of cushion at all from a financial perspective.
Right.
Like that sort of stuff right there just really irks me. And it's the reason why I want to talk about this today, other than to actually point out the statistics of how Americans feel about their personal financial situation. I got a lot more to talk about there. But first of all, this advice is just way too generic, right?
Yeah.
I'm actually going to get to the end of all this statistics. I want to lay out kind of the lay of the land, if you will, by providing all the people watching and listening to the program right now, like what are the statistics? And I'm going to give you the 3 generic things that most financial advisors are recommending, very much like the ABC soup from, Dave Ramsey and Susie Orman types. But then I'm going to give you my 3. All right. And then I want to get into some macroeconomic data today as well. So the other thing that was stand out here in this survey. So again, the survey from CNBC is called Your Money Survey. And 4,300 adults were surveyed on this across the United States. And 74% of Americans are feeling financially stressed. And that's up from 70%. And that was back in April when they did the survey. So they did it in April. They did it here again recently in August. And that actually increased from 70 to 74 over just a few months. We'll talk about why that is here in just a little bit. 37% of those surveyed indicated that they are, quote, very stressed about their personal financial situation. And back in April, that was 30%. So these numbers are trending in the wrong direction. The top stressors, according to those that were surveyed, inflation was number 1, rising interest rates number 2, two of the main topics that we've talked about for the last 18 months to 2 years. And then the last one is lack of savings. I think some of this stuff needs to be flipped and reversed. The very first thing, that we need to talk about here that I want to address as part of my topics are people just need to flat out make more money. And I want to spend some more time on that here in just a second as I finish out laying out the groundwork. Of course, inflation's an issue, but Warren Buffett famously said your greatest asset to fight against inflation is your own personal ability to make money. Right? You can improve upon those skills, right, over time. You could also start a business or create a second job. So all these things can help fight against inflation. And then, of course, understanding how to actually increase your wealth over time, not just paying down debt and putting a little bit into a savings account, which isn't actually earning you a whole lot of interest these days. So more to come on those topics. To finish out the groundwork here. So how workers are funding their 401k plans. So 2,700 respondents here of the CNBC Your Money survey were either employed full-time or part-time, these 2,700 folks. And again, 4 out of 10 said they did not want to contribute any money to the 401k, even though they could, which of course leaves the 6 out of 10 people that are contributing to a company 401k. So for those that are actually contributing to a company-sponsored 401k, 46% are contributing as much as they can. That's great. 24% are putting away as much as the company match, right? So let's say your company's matching 4%. Sounds like 24% of these people are just putting in 4% of their own money to get the full company match. Makes a lot of sense. Obviously, you want to do that if you have a job and your employer is willing to match a certain percentage of your contribution to a 401k. That's free money, You should at least be doing that if you have the ability to save in a 401k. So those 4 out of 10 people that are saving in a 401k, it doesn't say whether or not the company gave them a match. My guess is that there are, a good amount of those folks that do have a company match that are missing out on free money. 11% of those contributing to a 401k are saving up to this year's employee contribution limit, which is great. The current contribution limits for 401ks for those that are under the age of 50 is $22,500, which is awesome. And if you're over 50, you can save an additional $7,500 on top of that, which would be a total of $30,000 annually for those over 50. Now, lastly, 8% of those saving in a company-sponsored 401k just save the automatic default amount. What does that mean? That means you got hired and as part of your new job, you got a 401k, and your company just auto-signed you up.
Yeah.
Right? And they're going to put, 3% of your paycheck into the 401k. The big one is this. Nearly half of those contributing, the actual number is 46%. So almost half of those that are contributing don't know what investment choices they have within the 401k. And 56% of those that are saving in a 401k admit that they're not on track. So let's get back to the financial advisor recommendations. And this is, again, coming from the same CNBC survey. Their financial advisors are saying the top 3 things that these people can do to take steps towards resolving their stress about their personal financial situation. They're as follows. Number 1, save enough to get the employer match. Duh. I just talked about that. That's free money. If you're not, if you're not taking advantage of that, then give us a call. I can help you there. Number 2, boost emergency funds. And then number 3, prioritize paying off high interest debt. So this is like, Mickey Mouse stuff here. If you're not getting the company match, you're giving away free money. Obviously, people would like to have some additional cushion, being an emergency savings. A lot of financial advisors talk about the 3 to 6 months of whatever your monthly expenses are is what you should have in emergency savings. Clearly, that would be great if everybody could do that. And then paying off high interest debt. Let me give you my 3 recommendations in order. Number 1 is you need to increase your income, right? That can be done through just investing in yourself. Maybe you're a manager, and the one thing about every job that people have, if you're working for a company, the company can only stay in business if they have enough revenue, if they sell their product or service in enough volume at high enough prices to be able to pay their employees, pay taxes, pay for the 401k or whatever other amenities that company's providing, and also be able to generate a profit. That's what people are in business for. So if you're a person, you're also an entity. You might work for somebody else. You might not be, the CEO of a company or creating your own business or anything like that, but you are in self your own entity. So at that job, you should be selling yourself, making sure that everybody knows how valuable of a resource you are. And one way to do that, if you're, let's say, a manager at whatever company and you've never been in a quote sales job before where you had sales as part of your, annual compensation, maybe you raise your hand and say, hey, my boss, I want to go invest in myself and take some classes on how to sell. That way you can maybe teach the people that are working for you a better, more effective way about generating the revenue that the company needs so that they can keep their jobs, get the company match, and so on and so forth. So that can be done through a lot of different ways, not just investing in yourself. You could actually create, a side hustle. And that could be as simple as door dashing or Ubering people around. You could create, a small business for yourself, selling stuff online. The point is you as an entity need to focus on ways that you can drive more top line revenue, because that's what every business that's publicly traded and private, their main holy grail of existence and solvency for the future is to actually generate revenue. So we need to, as individuals, think a lot more like companies, whether, again, they're public or private. Their job is to drive revenue so they can stay in business and stay solvent for, a very, very long time. The second thing that I would highly recommend is educate yourself and or hire somebody who has that education. Like we just talked about here with these statistics. If 74% of Americans are saying that they're stressed about their personal financial situation, and half of those that are contributing to a company 401k have no idea what investment choices that they have, that should tell you, that's an indicator. Like if you don't have enough money, or if you don't feel like you're where you should be in life, whatever that means, that might mean that you don't know something about that specific topic.
Yeah.
Right? If you don't have enough money, there might be something that you don't know about making money. That is something that you can solve either by educating yourself, whether it's, looking things up on YouTube, Googling things. You could hire somebody. You can ask questions. There's a million books. Go read everything that Warren Buffett ever wrote. All those types of things give you the knowledge that you need to make better decisions, to understand what your investment options are, what that really means for you from a long-term goal achievement perspective. And then again, if you don't know what this is, you don't have time to devote towards all this stuff, that's exactly what my business is here to solve for those individuals that don't have that time to educate themselves. And the last thing is people don't take enough risk. They just simply do not take enough risk. And that could mean for a lot of people that are listening to this right now, they might be thinking, dang, how am I going to increase my income? I'm only making $60,000 a year at my job. Like there's no way that I can make, $200,000 a year at this job. Well, again, you're an entity as a person. There are a lot of people that I know growing up that worked multiple jobs, right? There's a lot of people that I know now, given the way that this society is with technology and the internet, that have little side hustles as part of what their income is. And I would say our generation, the younger folks in this country, I would say actually are trying to educate themselves to some degree, probably more so than other generations, just because we have, internet and AI and all this other stuff. They're only educating themselves, at the basic level. They're not taking it a step deeper. Like we talked about here with the ABC alphabet soup that, the Dave Ramsey and Susie Ormas have. And the last one about taking risk. It might sound like it's super risky to invest in yourself, but who can take that away from you, right? The worst thing that could happen is you went to go educate yourself and, you found out that you weren't necessarily a natural salesperson, or you weren't necessarily cut out to have your own business. The great news is that information is still retained. There's another way for you to go about deploying that.
Oh yeah, 100%. It's still a positive data, You're
investing in yourself like Buffett talked about. Yeah, that's something that can't be taken away. Inflation can't eat that.
No, you're learning your strengths too. Even if you find out that you're not as strong in some areas you are in another one, that's still learning your strengths.
And hey, guess what? Guess what the IRS tax code is built upon? It's built upon those that are taking risk. It benefits those that take risk. As a business owner, you get the ability to write things off. You have depreciable assets. You have tax shelters. And if it doesn't work, if it blows up in your face, whatever business or risk that you took, you get to write that off for the remainder of your life.
Yeah.
Right? I mean, you can literally go through bankruptcy and then start all over again and go about taking risks. Like the one thing that's for sure about, Vegas. I've never been to Vegas. I'm not a gambler. I don't enjoy, putting my money on a coin flip to see whether or not I might win. And it's usually not a coin flip. It's usually the odds are not, in your favor.
Yeah.
When you go to the gambling table and so forth. I'm not against those that do like to do all that stuff. So if you're going to be sports betting, great, go for it. It's just not my thing because I know the odds are not in my favor. And I don't understand everything that there is to know about statistics or fantasy football or, whatever. I don't want to spend the time to do all that sort of stuff to maybe give myself a better probability of winning more often as it relates to, gambling. But the one thing we know about Vegas, the reason why it never goes, belly up is because nobody seems to ever want to take on enough risk to win enough to actually take down the big casino. So I'm not saying that that's what we should be doing is taking risk in that regard. Let's all go to Vegas and take every dollar that we've ever had, including our home mortgage and college savings for our kids, and put it all on black. Like that's not the advice here at all. The advice is to take on more risk than what you feel like you might be capable of. And the reason why I'm saying that is not just through personal experience. Like I could not be more happy than I am today, only because I was willing to invest in myself and educate myself to get the knowledge that I need and the work experience that I had because of that investment in education to now be where I'm at today, which is way more risky than sitting down at, Fidelity Investments or TD Ameritrade, which is now Charles Schwab, and just sitting there, getting my company matched, getting my company benefits. Like I could have been fine.
Yeah.
Right. I could have been fine. But the thing is, I felt like I was living underneath my potential, right? I was being held back due to corporate red tape, if you will, of being able to fully utilize the skills and talents that I've been blessed with and that I've educated myself on and taken a risk on to fully service clients in the way that I felt like they deserved to be serviced. So for that, I took on the risk of creating Shepherd Wealth Management. I took on another side hustle job by creating this rental property business that's now about to expand. We went from a duplex to now 6 additional units on top of that here, probably closing here in October. This is the most risk I've ever taken in my life, but it's the most peace I've ever had.
Yeah.
Because I took all of those risks of going through college and putting myself in different, positions at corporate America types of jobs. And I used all of that as an experience to convince myself that, hey, when I die, whenever that is, hopefully a long time from now, I don't want to have this kind of highlight reel of my life and wish that I would have taken more risks. I wish I would have swung the bat more often. I wish I would have, maybe bet on myself a little bit more. I didn't want to go, to my deathbed having those regrets. Mm-hmm. We're all going to have some regrets in life. I'm not saying that this is, my way of washing over other regrets that I might have personally and professionally, but I wouldn't change it for the world. And like I said, even if everything doesn't work out, I'll still be okay. I can go get a job at Fidelity anytime I want to, Charles Schwab or any of those other types of places. I would rather go down swinging, or at least go down knowing that I tried my very, very best to achieve the type of lifestyle that I'd like to have for myself, my family, my community, and being able to service people the way that I want to. I'd rather take on all of that risk.
Yeah.
But I have so much more peace because I was able to put myself in a position to have success during that risk, but there's still risk. But the other side of that risk, you hear all the time, like, hey, if you have rental properties and you don't get them rented, or you can't keep them rented, or people don't want to pay their rent, or they're concerned about leaky plumbing or whatever it is. Yeah, that can happen. But what if it all works out? What if you can keep it rented? What if there are no actual big problems? What if when there is an issue, you can resolve it very quickly and satisfy your customers, and you can actually increase for a number of time, and maybe the value of the property increases as well. Maybe tax codes change that even benefit those entrepreneurs more than they already do today.
Right.
There's another side of that. You just don't hear that. I heard that from every friend, almost every family member, not all of them, but a lot of them would give you, oh yeah, this could happen. This is the reason why this might not work out. And you're going to hear the majority of that. But those are generally coming from people that have never tried to take on the risk that you're trying to take, or take on the investment that you're trying to make in yourself. So you just truly have to have this core belief, and it'd be great if other people were, around you supporting you, but just don't count on that. Right. And I think it is true. If you don't have some haters and some doubters, you're probably not taking on a right level of risk in some way, shape, or form. I actually have found that the things that I'm most afraid to do, when I kind of run towards them and lean into them, I get a lot out of it. Right. And I'm not saying that I'm going to go out there and climb Mount Everest, because I'm not that kind of guy. I don't necessarily want to jump out of an airplane either. But I am in a position now in life to understand that if I invest enough in myself, I can take on a risk that I thought I wouldn't be able to take, and I can actually have a lot of peace that comes from that, regardless of what the outcome is, because I know I can restack my chips and play again.
Yeah.
If things don't seem to work out. So that's my take. And I think it's completely different than what other people are getting from the quote unquote, financial experts like the Dave Ramsey, the Susie Ormans, like this CNBC article here in itself. It's not helping anybody solve their problem. There isn't any one of these 74% of Americans that haven't heard this before.
Yeah, 100%.
There's not one of them that haven't heard that before. What I bet they haven't heard is you need to make more money, you need to take more risk, and you need to educate yourself, or hire somebody that does have that sort of education. So that's the way that I would tackle it for all of those that are not feeling extremely satisfied with their personal financial situation. This is what I'm here to do.
Yeah.
Right. I'm going to look at this from a different angle than a lot of people would. and we'd be happy to help. Give us a call, 513-630-2664. So I thought that was worth talking about, Ez. I don't know if you had
100%.
anything in there, but it just stood out to me and wanted to make sure we spent some time on it today.
No, I'm glad you did. That's excellent advice. Yeah. And I mean, I think we've all been in a position where we can relate to the 74% of people that are stressed about their finances, especially after the year we just came through.
It's crazy, man.
You know, and I just had a thought. I mean, I wonder how many of those people had to maybe pause a 401k contribution just for briefly to combat inflation. You know, I can see that being a stopgap, especially like, let's say you got several kids, you throw in with, childcare because you can't afford to rent a nanny all the time, or, you can't afford to help it. So you have a full-time job taking care of kids. I can see you needing just to be like, all right, for this month or this year, we're going to pause the 401k contribution because we got to eat.
Right.
Because there's just only so many hours in a day. And a lot of workers, they just can't take on another job. So especially when we just got through the year and a half that we did. So I think great advice. And, like all those surveys, man, they do a horrible job of adding context to what they're asking. It's like if you ask somebody, hey, are you worried about cash? Would you like to make more money? Everyone's gonna be like, well, yeah. Everyone would probably say, I'd love to make more money.
Yeah, I mean,
that's a ridiculous survey. Like you just pointed, it doesn't actually help anyone with anything.
Think about it this way. Like there's 2% of the American population that makes $250,000 or more. So either the system is rigged against 98% of the people in this country,
100%,
or maybe that 2% did some of these things. They educated themselves. They took on additional risk so that they could actually drive more income. Right? I believe that that's the formula.
I mean, also though, capitalism's a zero-sum game, man. For someone to make more, someone's got to make less. So that is also part of the system. And not everybody can make $250,000 a year. We don't live in a world where that's possible.
I don't think that $250,000 would make everybody happy. I'm not saying that that's where happiness would come from by any means. But if you are in this situation, if this is a true stress for you, there are ways to handle it. And it's not just, hey, I'm going to pay off all my debt. Not all debt is bad.
No.
And you can't just say, hey, I'm going to create an emergency fund. Well, what if you can't? What if you are that person?
Yeah.
Right? You have to figure out another way to make more money. And the great news is with technology today, there are more opportunities for that. You just might have to spend more time educating yourself. And then once you have that education, I believe you'll have the courage, the cojones, if you will, to take on the risk that you thought that you would never take.
Yeah, 100%.
Which is the reason for my recommendations on this being a lot different than what other people from the survey made I've heard before. Now, that was a lot of fun to talk about. I'd love to hear your comments, questions. You can drop those right here on YouTube Live for us. You can text me 513-630-2664. Go to the website, shepherdwm.com. You can find my email there and email me directly. Love to hear your thoughts about that. If you are that type of person that feels that and you're looking for other ways to address that problem, I'd be more than happy to give you my thoughts on it. So moving on, we do have some data and some other macroeconomic events to get to here. So September is starting off a little rough here. However, our base case here at Shepherd Wealth Management remains that we see stocks moving higher in September, driven by what we expect to be softer inflation data, specifically coming from used cars and CPI, along with further evidence of softening labor. So I know that labor came in a little bit hotter than what people wanted to see. There was a little bit more from a jobless claims perspective, just pulling up that number right now. We were expecting 230,000 initial jobless claims. Data came in today at 8:30. It came in at 216,000, meaning that there were more people at work than we thought there would be. To me, that's a great thing. The market didn't necessarily love that because they're worried about the Fed increasing rates. But here's the thing. They've revised the last 3 jobs reports down 355,000 jobs. Now that's a lot. It doesn't get talked about at all, at least not on CNBC. I haven't seen it.
No, I've not heard about it.
So we see all these headline jobs, but people don't tend to look back and say, oh, this thing got revised substantially downward. So it's not as robust as what we thought. And you're kind of starting to see that in the unemployment rate ticking up from 3.5 to 3.8, the last number that we got. We'll get another number here this month as well. And collectively, this would change consensus. So if inflation's falling faster than people think and the labor market isn't quite as tight as the numbers might suggest, this would change the whole consensus view on future rate hike path based on the Fed. And that's what's putting pressure on the market. It's causing interest rates to actually rise. Now, the good news is some Fed heads, if you will, have come out to talk about this specifically.
Yeah.
Fed Governor Chris Waller was interviewed on CNBC just a couple of days ago, and he noted that while last week was, quote, a hell of a good data week, end quote, supporting a September pause. So he's saying, hey, numbers look great. Let's not do anything with interest rates in September. He also noted that, quote, one more hike wouldn't necessarily throw the economy into recession if we do feel we need to do one more. So, like, why in the hell do you even say that? I'm not even joking. I wish I could pull up a chart here for everybody. If you look at the 2-year and the 10-year treasuries, the second that guy said that, it was all coming down, meaning that interest rates on the 2-year and 10-year were coming down.
Yeah.
And the market was rising, so equities were coming up. And as soon as he said that, well, we probably wouldn't jack up the whole economy. If we did one more, we might fit one more in there just for the hell of it.
Yeah.
Well, I mean, without any real data at all.
Just because YOLO.
Makes no sense. And this is why people are so confused is you got, these Fed heads, these people are supposed to know everything about interest rates, the economy, and the pressure it puts on the banking system. And then wrapping it all up into an interview saying, yeah, man, data was awesome. Hell of a good data, quote. Follow that up with, I might fit in one more just for the hell of it. Why? And as soon as that happens, here's what happens. So the November hikes, the last comment that Fed Governor Chris Waller said, the latter comment could be a reason the odds of a November hike jumped to 41.4% yesterday. It went up 9.3% just on those comments and caused the market to sell off. The 10-year moved up to 4.264%. Right now it's hanging out right around the same level. It jumped 8 basis points on the back of those comments.
Oh my Lord.
So, these conditional statements are not necessary. Arguing the November hike is in fact important to do. But it does show where the Fed perspective sits, and many remain unconvinced the economy has softened sufficiently. I don't know what data points these folks need to see, but we've seen a softening of labor markets. The data's there. Unemployment ticked up. We're seeing it in the revisions. And you've seen nothing but deceleration of inflation, meaning inflation's been falling for several months in a row. We're about to get CPI again next week. So hopefully that's the nail in the coffin for those that are not convinced that we're moving on a glide path towards that 2% inflation target. I think we'll finally get that wrapped up here this month. So that's a big part of our consensus. Now, some might argue, hey, there's a huge headwind for stocks due to the rapid increase in oil prices. Yes, WTI crude has risen almost $10. It's up around 87 to 90 bucks just in the past 7 trading days. And we're basically at the highest level since November of 2022. A lot of this has to do with the Saudis' production cuts. So this is a supply issue. This is not a demand issue. The Fed themselves have stated repeatedly for years that they cannot affect the supply side of the economy. They cannot at all. They can affect demand, and that's what the cause of raising interest rates will do. People will say, oh, my credit card interest rates, went from 18% to 27%. Car loans go from 4.5% to 9%. That increase in interest rates, that cost of funding is what slows down demand. That's what the Fed can actually have a direct impact on. They can do nothing about the supply of oil. They can call the Saudis and the Russians or wherever else they want all day long and say, hey guys, we really would appreciate it from an inflation standpoint if oil wasn't as high as it is. They don't give a rat's ass.
Oh yeah.
And and the truth is, if you were sitting on that oil if you were part of OPEC plus, it was like OPEC plus Ezra.
Yeah. It should be.
And you had this big oil well that you could just tap into and ship it out in other parts of the country. If you had that ability, why would you want the price to come down?
I wouldn't at all, especially when I'm assuming the people that are in OPEC plus as are at least forward looking enough to see the writing on the wall with where fossil fuels are going. and that it literally, no pun intended, but it is flat out a dinosaur, right? I mean, eventually within the next couple of decades, it's just going to drop off to almost maybe not even really being used.
Right.
So yeah, why would I already make this cheaper when I can just be a jerk about it and stranglehold the world to give me the maximum amount of money for the little bit of time I have left?
You're not wrong.
That's exactly what their mindset is. It's like, well, everybody's going to be doing electric stuff in 20 years anyway. Might as well just choke them for what they got now.
Yeah. So, you know, that's, I grant you that is something that could be a concern, but the Fed's favorite inflation measure is the core CPI, which where they strip out food and energy because it can be a volatile commodity, if you will.
Yeah.
And they know that they don't have any direct impact on the supply side of food or the supply side of oil, as an example, which is why they stripped it out. Now, they do have to pay attention to the headline CPI, which I'm going to talk about here in a little bit more detail in just a second. But to us, the bigger story this month is we expect core inflation trajectory to come in softer than consensus. And this leads to the market and the Fed repricing the future path of rate hikes. The most notable being we believe the Fed will not hike in September nor in November. And currently the Fed funds see about a 7 to 9% chance of a possible rate hike in September. And as I mentioned, over a 40% chance of a Fed hike in November. That's what's priced into the market right now. Now, the two data points coming in this week, tomorrow at 9 a.m., we get the Manheim used car price index, which is huge. So a huge chunk of the actual CPI calculation comes from used car prices and new car prices. Specifically, 57% of the CPI calculation is coming from housing and auto related, which means new and used cars, as I mentioned there. So that's an important data point that we're going to get tomorrow at 9 a.m. And I expect used car prices to continue to fall off a cliff as they have been in the preceding readings that we got from the exact same measure. And then next week on the 13th at 8:30 in the morning before the market opens, we get the latest CPI, the headline inflation number, which I also believe because used car prices are going to be falling. And I also believe that shelter prices are going to actually start to show up in the CPI data that have not really shown up in the CPI data in a bullish perspective, meaning that lower inflation from shelter has not crept into that data point yet. And it eventually has to. I mean, that's one thing that the Fed actually acknowledges from a lag effect. Shelter is one of the last things that actually will show up in the CPI print. But we started increasing interest rates in March of 2022, and now we're in September of 2023. So we're about that, the Fed talks about being 12 to 18 month lag effect. We're getting pretty close to that 18 month lag effect.
Yeah.
So I got to believe that the housing data is going to start to show up in a positive view, meaning lower inflation for housing in that CPI calculation on top of what should be a substantial decline in the price of used cars, which is a dramatic difference from consensus. And again, this is the reason why you're seeing the 2 and 10-year interest rates increasing with almost no data to speak of so far, again, until tomorrow. It's all having to do with people's perception or what they think the Fed might do with interest rates. Now, continuing this thought here, it is fair for someone to say that a weaker jobs and softening inflation are consistent with both a hard and soft landing. So again, we have this issue of, weaker data might mean a soft landing, but it also can mean that we're losing too much growth too fast, and therefore we might have this hard landing. The Fed study by former Fed Vice Chair Alan Blinder shows that most tightening cycles end in soft landing. What leads to a recession is a substantial shock, right? And so an example would be 2008, we had the great financial crisis. We had an oil surge in 2022 due to the Russian-Ukraine war. We had a credit shock in March of 2023, earlier this year when Silicon Valley Bank fell. We saw a 27% stock market fall in 2022. So the equity market and the economy have already endured these shocks.
Yeah.
Right? It's already happened. In fact, in early 2022, we saw 2 consecutive quarters of negative GDP. We made it through that as well. and you didn't call for a recession last year, even though I've mentioned many times that last year was the classic definition of a recession. The only box that it did not check was unemployment. Now that doesn't mean that we couldn't see that type of shock, in the future. It could happen from things like the redemption of student loans that are getting ready to happen right now. I mean, interest is rolling right now for all of those like myself that still have student loans. Interest is racking up yet again. Payments have to start being made in October for all those that have student loans. Now that in and of itself is kind of like having the Fed increasing interest rates. There's just less money for myself as a consumer to spend because now I have to pay student loans back. You could see a United Auto Workers strike. That could be a huge problem if that sustains itself for a long period of time, kind of like what we're seeing in Hollywood. Yeah,
I mean, that we almost had another scare with the UPS. We avoided that strike. That could have been disastrous, especially coming up to the holiday season.
Yeah, no doubt. And then we also have a possible government shutdown, although, I don't think that's going to happen.
No, it'll never happen. They'll never not get paid.
Well, definitely going into an election year next year also. So I don't necessarily count that one as much for risk, but I guess it could happen. People were talking about it, when it was a imminent possibility.
Yeah.
Earlier this year.
Remember? And you were just like, no, what's the actual chance of it happening? Zero.
Self-preservation is a powerful motivator.
Powerful thing.
All right. So bottom line for us here at Shepherd Wealth Management, September is not off to a great start by any means, but key fundamental data points to later this week, softer inflation data will change the consensus view of what the Fed potential rate hike path may or may not be. So we're about to get some more of that data coming up here, as I mentioned, Friday, and then next week on the 13th is CPI, which is huge. Now, we actually view this current week up until tomorrow kind of like dead space, right? Which is why you're seeing all this emotional reaction with interest rates and the equity markets until we get to some of that data. But one thing that we did get on Friday, September 1st, so last week, was ISM manufacturing data. This came in at 47.6. This is 3 consecutive months of improvement. This could be seen as a sign of a bottoming process that has occurred, and now we're starting to move up because we have 3 straight months in a row of that. And the interesting data point here is this bodes very well for industrial stocks. Since 1950, when PMIs are less than 47 and improving, which is what they are right now, they were less than 47. Now they're improving above 47, 3 consecutive months. The win ratio for industrials over the next 12 months is 95%, meaning 95% of the time over that preceding 12 months, you're making money with a median gain of 22%. So I've talked about this since October last year, that the recession happened in 2022 and that we should expect 2023 to be a year of opportunity. And you likely would see technology and industrials being the best 2 performing sectors, followed by energy being our 3rd favorite. So our view hasn't changed in any way, shape, or form here for our customers at Shepherd Wealth Management. And we've talked about this for an extremely long period of time. But truthfully, the only major risk in the marketplace as we see it is people's perception of what the Fed's going to do with interest rates. If they're done raising rates, they're not going to do it in September, and they don't end up doing it in November because inflation's on a glide path towards 2%, then you have to start considering rate cuts at some point in time in 2024. My view is it'll probably happen sooner than later in 2024, because why keep interest rates so high on the Fed funds, that cost of capital being extremely burdensome, specifically for regional banks that have, mortgages and then, commercial property on their balance sheets, and they're getting crushed with their bond portfolio right now because they probably bought 10-year bonds paying 2% and rates are now over 5%. Why have that added pressure on the financial system and the consumer if inflation is now hitting our target of 2 or something close to 2%? Why keep them there? It would make no sense to keep the economy restrictive at that point, which would actually be a great tailwind for equities going into next year. And the market's going to look 6, 9, 12 months down the line. So yeah, it might be a bad start to September here, but if the data comes in the way that we expect it to, this is all going to turn around very, very quickly, which is why we're bullish in the month of September, where historically September is like the worst month of all 12 months from an S&P performance perspective. It just is, right? There's no way of getting around that data. But the last data point here that kind of supports our thesis is from a historical standpoint. If you do go back over, since 1950, we've had several instances where we've been up 15+% in the S&P 500 through August. Mm-hmm. And the average return for September under those circumstances is about 3.3% on the S&P 500. So history actually would support this September being positive, but everything is going to hinge on this inflation data. What are used car prices looking like tomorrow morning? And what is that going to mean for CPI when we get that on the 13th? If we get light numbers being below consensus on the used car prices tomorrow morning, that's going to flow right into CPI next week on the 13th. And if housing actually shows up and showing deceleration of inflation there for the first time, we should be hitting a number below consensus on the CPI, headline number there. And that, in fact, will change everybody's perspective about the future path of rate hikes. And therefore, you would probably likely see the 2-year and the 10-year treasuries start to fall, interest rate rise.
Yeah.
And the markets start to rally across the board, Dow, S&P, as well as the tech-heavy NASDAQ. And small caps be a huge one for them as well. So that's where we stand. That's everything that we wanted to cover today. I know that we're right up on time here. Ez, is there anything else we're missing that we want to make sure the viewers hear from us?
I don't think so. I just want to remind everyone that whether you see this live or come back and check out the episodes later, if you have any questions for Joshua, you can text in the office or leave your questions in the comments.
Perfect. And we'll definitely be doing this again. We try to do this about every 2 weeks.
Yeah. Keeping a good schedule past few months.
No doubt. And some more enhancements likely coming for the program as we go along here. Certainly appreciate all the viewership, all of those that are liking, subscribing to the Shepherd Wealth Management Podcast, whether you're doing that right on YouTube or Spotify. You can find both of those platforms for the podcast on our website, shepherdwm.com. There's links to take you both to Spotify as well as YouTube. And definitely check out the website because we're posting our Friday blogs there. Kind of summarize the week, what happened, why, what we look forward to next week, provide some historical references for everybody on Fridays. You can check that out. Again, shepherdwm.com. And while you're on the website, you can check out all of our newsletters. So since the beginning of this year, we've been posting the monthly newsletters right on the website for everybody to view. It's really just for clients, but I wanted to put it out there for everybody else that would care to read that and then get something out of it. So we'll do this again in a couple weeks. It's been an absolute blast. I hope you guys enjoyed that, got something out of it, and we'll catch up with you in 2 weeks. Have a great rest of your Thursday.